Well. Thanks so much for having me. I can't tell you how much I appreciate it. It just means a lot to me that I'm able to speak to a new audience. People can
Yeah,
hear my message.
yeah, you're very welcome, man. So I'm looking forward to bringing you on. I want to give everyone a little bit of a quick introduction on how I tracked you down. So this is Howard Weiner. We've been chatting um, on LinkedIn for a while, and I kind of been following a lot of his posts, a lot of his videos. And he's just been making some good content. And as you guys know, it's one of my goals to become a little bit better at macro scales and macroeconomics and just the really, really big picture as it relates to the stock market and stocks and equities and trading. So I figured I would just reach out to Howard since he is an economist and just get some insights, get some information, learn a little bit from him. So Howard, thanks for being on the show.
Thanks again, Jeremy. Like I said, I really appreciate it.
Yeah, you're welcome, man. So give us a little bit of background on yourself, man. Where'd you come from? How's life? How'd you get involved in this world?
Sure. So I grew up in suburban Philadelphia. I went to public school, and I guess you could say I got my start with money and finances as a child. My grandfather used to talk to me all the time about these kind of things, and he started buying me municipal bonds when I was maybe 10 years old.
Mm.
But I didn't really have too much interest at the time. I mean, I was only 10. I was more into baseball. But I went to college. I got a degree in business administration, and my real passion is economics. I started reading all kind of books about personal finance. I started like everybody else. I started with Rich Dad Poor Dad from Robert Kiyosaki.
Oh yeah.
Uh, and I think there's good reason that it's the all-time best-selling personal finance book of all time. So I started there, and it just really sparked an interest. I read tons of books on personal finance. I started reading books about economics. I'm just like a real bookworm when it comes to these things. And I got into the financial industry maybe like 7 years ago. I started with New York Life as a salesman selling life insurance. And I moved on to a firm where I could sell securities as well, which is mutual funds, stocks, bonds, ETFs, REITs, all kind of stuff like this. And I'm not there anymore. It just really wasn't the right fit for me. But excuse me, I'm still involved, and I watch the economic trends. I watch the economic indicators every day to see what's going on. And I just at this time I'm getting ready to go to grad school to get a degree in finance, but I still do some consulting with families these days. It's kind of like I guess like a side gig, if you
Yeah.
will. But I'm gearing up to go to Baruch College in Manhattan and do a degree in finance, an MBA in finance with a focus in banking and hedge funds.
Right on, man. Okay, very cool. So you mentioned some economic indicators. What would be some of those? What's some examples of that?
Yeah, sure. So one of the things I like to look at is unemployment. And most people, when they hear unemployment, it's like, oh, 3.5% hasn't been as low in 50 years. Well, no kidding, it hasn't been that low in 50 years, but that's not the real unemployment report. And that's not the real numbers that you really want to look at. You really want to dig into the report and see where those trends are coming from. If something is trending down, for example, manufacturing has been trending down for something like 30 or 40 years, and service has been trending up. So all the jobs, any new job creation is always coming from the service sector rather than manufacturing. So manufacturing is things like automobiles, machine parts, and computers, electronics, anything that people are making in a factory, food and agricultural products. That's although agriculture is separated out from food, but this is manufacturing. And service is things like accounting or accounting services, real estate and real estate services, hotels, entertainment. These are all services that people provide. And it's all separated out by category in the unemployment report. And you can see which things are gaining and which things are losing. But there's real problems with the government issued unemployment reports. For example, they admit that they fudge the numbers. They also admit that they only call about 1,000 households to extrapolate the data for the entire nation. So a nation of 350 million people or 330 million people with 160 million in the workforce, How do you extrapolate up that data from 1,000 people? Another thing that they do to fudge the data, for example, the last job report a couple weeks ago, about 48,000 workers from GM, General Motors, they went back into the factory to work. They really weren't unemployed, even though the government had counted them as unemployed the month before, and then counted them as newly employed 2 weeks ago. Well, they weren't unemployed. They were striking. They were out of work for what, 2, 3 months? So they weren't working during that time, but it's not like they were unemployed and looking for a job. Like, for example, if my neighbor loses his job, he's got to go find a new one. These people didn't lose their job. So these numbers are all fudged to a certain extent. That's one major indicator I look at. I look at the ISM, the manufacturing indexes. I look at the Baltic Dry Index. I look at inflation. I look at quite a few factors here. Some of them are totally fudged by the government. Inflation is another example of one that the government totally fudges. Some of these other things are very independently calculated. The Case-Shiller S&P 500 index, for example, they calculate the valuation of the stock market. So that's independent, and I trust that much, much more than I do the government statistics, because Robert Shiller has his career riding on it. So that's his incentive. If he fudges the numbers, he can lose his reputation. He doesn't want to do that. The government fudges the numbers to their favor. So, I look at the numbers, but from the government, but I take it with a grain of salt. Case-Shiller is great. The housing indices that he produces, the 20 city, the 10 city.
I do like that a lot.
Yeah, it's great because, again, he's a guy that has an incentive to do it. He gets paid real money. Well, I wouldn't say real money. He gets paid cold, hard cash. Let's say it like that. And we'll discuss that if you want, why I make a differentiation. But he gets paid cold, hard cash to create those indices. And his whole career rides on the accuracy and the suitability of the research that he does. So he's somebody that I'm much more inclined to trust than the government. And there's various other indices that you can look at. The stock market itself is a great index to look at, whether it's the NASDAQ or the S&P, the Russell 2000, all these kind of things. And if you look at any of these individually, you may get one idea about what could be going on in the economy. But when you look at everything as a whole, it really gives you a really good picture. I liken it to looking at a puzzle. You look at the cover of the box that the puzzle comes in, you see the whole picture. It could be one of those beautiful paintings from Monet or Renoir. Could be a cartoon, but you see what the whole thing is. If you look at one or two pieces of that puzzle, you may have an idea what it is, but you probably don't have a clue. And it's the same thing with all these economic indicators, all these charts that you look at. It's really the same thing. You really have to look at so many things to get a good picture of really what's going on.
Which makes sense. Do you have a place that kind of amalgamates all this, or do you find it all separately in different websites or other articles online?
Yeah, it's a great question. There's a few places that I look. One resource that is from the government that I actually do trust much more than others, the St. Louis Fed has, meaning the St. Louis Regional Federal Reserve Branch, they have a system called FRED, F-R-E-D, FRED. And they have all kinds of statistics and analysis of what's going on in the country. And that's really, with FRED at the St. Louis Fed, that really takes into account the whole country when they do their statistical gathering and analysis. So you can look at tons of stuff over there. You can look at, for example, the spread between the 10-year and 2-year Treasury note. You can look at, that's it. All kind of stuff. You can look at defaults on commercial loans from all banks. You can look at home sales. You can look at home pricing. A lot of different things. Usually what I do, Jeremy, by the way, I don't go straight to their website. I'll do, for example, I'm typing now as we speak. I'll type into my computer in Google um, defaults at all commercial banks. And when that comes up on my screen, the first thing there is delinquency rate on commercial and industrial loans, all commercial banks. The second one also. So, and that's what I click on, and it's going to bring up a chart for you when you click on it. Oh, you got the same thing on your screen too, I see. So, for example, delinquency rate on consumer loans, all commercial banks. Well, we can see that since, if you click on that, you'll see that since since 2015, delinquency rates are rising. And I'm not so interested in what it's doing month to month, though I may look at that from time to time. I'm more interested. Oh, you got a different chart than me. You got delinquency rate on commercial industrial loans. Let me change it.
Yeah, I clicked on the first link. Sorry.
All right, so you got the first one. I'll click on the first one also. So the delinquency rate on commercial industrial loans at all commercial banks. Well, here also, since 2015, there was a little bit of a spike into 2016, and then it started coming down in 2017. But we can see since about the last quarter of 2018, it's rising again. That's the little bump right down there, yeah.
Yep.
You can see it's starting to rise again. And even if you go back all the way to the first quarter of 2015, the general trend is still that it's rising.
I see.
So I look at stuff like that and I say, well, the general trend is rising. Where do we normally want to see it located? And we can see that it only shows since like 1987 here. So we can see since 1978, the general trend is down. And with each successing trough, we see the trough goes lower and lower. And with each successive peak, we can see the peak also going lower and lower. So it's moving in a direction that we like, because we don't want to see defaults on loans, obviously. But if the defaults on loans are rising, then we want to know why. And it's typically because there's trouble in the air. So in 2016 and into 2017, that was when Jerome Powell and the Federal Reserve started tapering bond purchases and raising interest rates in earnest. Before that, the first rate hike was 2015. Janet Yellen raised a quarter point. In 2016, they raised a quarter point again. But in 2017, that's where the rate hikes started coming, and that's why we saw that there was a spike in defaults, because anybody who had a variable rate loan, or anybody who had a loan that had to roll over, regardless if it was business or personal, so those rates were going up at the time. So
interesting. Okay.
Yeah.
So just to switch gears a little bit, what as an economist and someone with like a kind of a broader general disdain for the government,
yeah, I mean, I do and I don't. I guess you could. I mean, they admit that they fudged the numbers, Jeremy. So
I mean, I'm not going to deny what you're saying. I like the disdain, man. I'm with you. So, but what do you find that you invest in then? Like, what's something that you find comfortable or sustainable that you enjoy?
So, you mean as far as where I look for statistics and analysis to get my broad view, or do you mean something else?
Yeah, just like specifically, are you investing in real estate, residential or commercial, or do you do bonds, or do silver and gold, any kind of equities?
Yeah, so right now, I don't have too much in the markets. I have a little bit in the precious metals arena, as far as some precious metal. I have silver and gold, and I if people want to invest in that, I recommend two things. One is only buy bullion bars and coins, unless you really know what you're doing with the collector's pieces, because the collector's pieces aren't worth it. Unless you know what you're doing. And if you know what you're doing, then it's worth it to you to pay the premium on it for the collector value of it, but not for the actual melt value of the coin.
Right.
So, but I have very little precious metal right now, and I have a small position in precious metal mining companies. And if you want, I'll tell you which I'll tell you which companies and mutual funds I own and which ones I recommend as well. I don't mind to do that.
Sure.
Yeah. So as far as the funds, I own the Euro Pacific Gold Fund, which is with Euro Pacific Capital, Peter Schiff. I'm sure you probably know the name. Maybe a lot of your listeners know his name. So I own his gold fund.
Yep.
And I also recommend, I used to own, but I had to pare my position. I used to own the same thing from Sprott. I own the Sprott Junior Miners Fund, which is an ETF, and also their ETF on the mining industry. So Euro Pacific is EPGFX, and Sprott is SGDM and SGDJ. SGDM is the majors, and SGDJ is the juniors. So I owned both of them from Sprott, but I had to close out my positions for personal reasons. But I still love them, and it's a great group of funds. The reason I like these three particular funds is if you go out and buy a Vanguard Gold Miners Index fund, so a company, and I have nothing against Vanguard. What I don't like about the fund is that it's typical for the industry that they just buy whatever is out there without regard for who the management team is, without regard for the financials of the company, without regard for whether or not it's a viable concern going forward. They just buy. And some of them buy according to market cap. They'll weight it according to market cap. Some of them just buy equal positions in maybe the top 50 or 60 companies in the industry. But I don't like that approach. I like Sprott's approach, and I like Euro Pacific's approach much better because they really go in and take a look at the companies, and they look at who the management teams are. And I would warn your listeners, Jeremy, also that if you're looking to analyze resource extraction companies, regardless if it's precious metals or base metals or oil and gas or uranium or rare earth metals, you got to be really damn careful about what you do with it, because it's not like analyzing Microsoft or Google or Intel or Advanced Micro Devices or Redfin. It's not like analyzing a regular company, because there's just so much that different with a company like this, where they're pulling something out of the ground and then going ahead to refine it.
Yeah.
It's a very, very different analysis. And if you haven't learned how to properly do it, it's not worth it. And just stick with the funds. And that's what I would recommend. Companies that I like in the precious metals arena, regardless if it's silver or gold or both, I like companies that are something called a streaming company. And what a streaming company does is they kind of act like a bank towards the resource industry. And you have it in precious metals, you have it in base metals, you have it in energy. So a streaming company sort of acts like a bank, because they either lend to the mineral extraction company, or they provide the funds with in exchange for shares or warrants, things like this. Really, the best way to do it is to get a note where they're paying interest, and on top of that, get warrants to purchase shares maybe 3 years down the line. At a discount price. So if you can get a warrant that's like 52 cents a share 3 years from now, and shares are currently trading at 25 cents, well, 3 years from now, if that precious metal company or that energy company is going to be able to really build out their mine or build out their wells and become profitable, so shares could be worth $5 to $10. So now you're buying shares for 52 cents and flipping them for $5 to $10 on the open market. And that's the best way to do it, if you can. So you got to be a precious metals streaming company or an energy streaming company to be able to do that, or you have to get in on a private placement with one of the big players, like Marin Katusa or Sprott, any of these guys that can do that. But these streaming companies really, the reason I like them so much is because their business model de-risks what's going on in the precious metals or in the energy sector, or whichever sector it is with resource extraction. So they take away all the risk by saying to, like, let's say Wheaton Precious Metals is a good example. Let's say they're lending to, I don't know, let's say they lend to Pretium Resources. which is a gold mining company. They've got a mine called the Bruce Jack Mine up in British Columbia, I think it is. And the main place where they're doing their extraction right now, it's called the Valley of the Kings. And there's a really good reason for that, because they're pulling out 15, 20 times the amount of gold per ton of resource. In other words, they pull a ton of dirt out of the ground, and they're getting 15 to 20 times the amount of gold out of that dirt as most other gold mines in the world. So it's a major gold mine. And if I'm Wheaton Precious Metals and Pretium Resources tells me, hey, I've got another mine called the Snowfield Project. We know the resource is there. It's 10 times bigger than our Bruce Jack mine. It's not as dense with the gold and the silver as the Bruce Jack mine. It's only half as dense, but we've got 10 times the resources. Well, half as dense means they're pulling out 8 or 10 times the amount of gold if that thing is viable economically. They're pulling out 8 or 10 times the amount of gold per ton. And then if that's going to be profitable, well, we have to look and see if it's profitable. And if I'm Wheaton Precious Metals, I'm going to look at all their studies, and I'm going to do all my own studies. And if I decide to lend to them, maybe I lend to them $1 billion to finish the studies and build the mine. And then once the resource starts to come out of the ground and they start pouring bars of doré, so all of a sudden I'm getting $500 an ounce of gold on every single ounce that sells out of that mine. So if I'm getting $500 an ounce, that's going to take what, 2 million ounces till I get my $1 billion back? And I'm still getting more after that. And in the meantime, I'm going to get 8 or 9 or 10% interest on the note.
Gotcha.
Maybe I get warrants along the way also.
Yeah, Howard, so speaking of, you mentioned an interesting term that I haven't heard about, and I really haven't talked much about. And I think it would be really cool to get some of your insight on it. Tell me about warrants. What are they? How do they work? Why are they?
Yeah, so it's basically the same thing like an option, except for the time frame. So your listeners who are trading options, they'll know that if I own a call option, that means that at some future date within the next couple of months, I have the right, but not the obligation, to buy shares from you. So if you sell me the call on Microsoft, I have the right to buy your shares of Microsoft at a certain price in the future.
Yep.
And warrants work the same way, except that it's very long term. A typical warrant is about 2.5, 3 years, maybe even 4, but typically they're much longer term. So they're used for companies much more often that are young companies. You're probably not going to see warrants for Microsoft except in special situations, but you will see warrants for a company like Pretium Resources, who I mentioned, where they've got a project that they need 3 to 5 years to bring to fruition. So if I'm the one lending, well, maybe I lend them $1 billion. I get 7% along the way. And to pay it off, they have the option to pay me cash or shares. And I also get warrants for 1 million shares. And my warrants are for 50 cents a share. And that, again, that gives me the right to buy shares at 50 cents in the future at whatever the date is that the warrants are dated for.
Where do you buy them?
It's typically with a private placement, at least in my experience. It's typically with private placements, unless you're, one of the big guys in the resource industry. If you're like a Ross Beatty, or maybe even a hedge fund, like if Ray Dalio comes in with Bridgewater and says, "Yeah, we'll lend you the $1 billion." So guys like that, they'll be able to get the warrants directly from the company. Otherwise, you got to buy them on the open market if they're available, but they're typically not going to be available anyway. Because if I'm buying warrants in Pretium Resources for 3 years from now, that's because I think that I'm going to be able to get those shares at 50 cents and sell them for $10.
Right.
And for 3 years, it's not worth it for me to sell you the warrants for a dollar or $1.50, $2 each. Now, if I'm gonna sell them for $10 in 3 years, I'm gonna get such a better return on my money. And it's typically people who are owning the warrants are much bigger investors who have the time to wait. So people who have $10,000 in their Ameritrade account, they're probably not getting their hands on the warrants. Probably not at all. They got to wait till they got millions before they're doing that. I mean, not necessarily millions. They could be in Ray Dalio's hedge fund and participate if it's offered to them. But it's typically going to be the big guns that are coming in, which is, again, it's going to be either the institutions or the hedge funds or private placements. They're typically the ones that are doing the warrants on projects like this.
Got it.
So now that's with resources. In other sectors, it could be different. I know a little bit more about resources because I like gold and silver, and I've studied it quite extensively. But at least in gold and silver, in energy, that's where you're going to be able to get a hold of warrants more easily. But again, you got to be a big investor, or you have to participate with a hedge fund.
Got it. No, that makes sense. I appreciate you sharing that information with us because, yeah, like a lot of people don't hear a lot about those. What about bank notes? Or is that something that you specialize in or know a lot about?
Not at all, actually. And I'm not afraid to admit that I don't know, because
Sure.
I'd rather tell you I don't know than say, like try to fudge my way through it and tell you something wrong. I don't want to do that.
Absolutely get it, man. So bring me down to this. How did you come up with the branding of the Mad Genius? Like where did that come from? Tell us a little bit about how that transpired. Mad Genius Economics.
Sure. So I started writing. When I started writing in 2016, I started posting to Seeking Alpha, and your listeners can find my work there. I posted about 18 articles since September 2016 to Seeking Alpha. I've also posted in other places. What's it called? Can't remember the name right now. There's another place. It just escapes my mind. I'm sorry. But there's a couple places. I mean, if you listeners just look up Mad Genius Economics, they'll find me.
Sure.
I've posted a lot of personal finance articles to medium.com, also under Mad Genius Economics. And there's one other website, like I said, it totally escapes my mind right now. But I started doing that in September 2016 because, like you read the newspaper, the financial section of the newspaper, or you read the financial newspapers like the Wall Street Journal or Financial Times, and their articles paint a very different picture than what I think is really going on. The underlying fundamentals of the economy are not what you see in the headline numbers and the headline news. It's just not at all. It's not one and the same. So, and like I said, if you dig into the employment report each month, you'll see something very different than that headline number of 3.5% unemployment. So I was very inspired to start writing and put my thoughts out for people to be able to see it. And that's how I got started. And then a friend of mine on LinkedIn, I guess I'll give a shout out. Her name is April Maresca Yeager. She was the one who named for me Mad Genius Economics.
Oh, okay.
Because she kept telling me that, like, oh, you're a mad genius. You're such a genius. I don't think I'm such a genius. I just observe what's going on around me and say, like, does this make sense or not? And then I look and see, well, this is what was said, but I have evidence in these 4 other places that says that it doesn't make sense. So that's how I got started. So right now, most of my work is on LinkedIn. I do videos 2-3 days a week, sometimes 4 days a week. On Sundays, I have a specific series called Straight Talk Investing, which is more geared to my readership and their questions. So if somebody wants to ask me, like, hey, Howard, I'm 42 years old. I got 2 kids. I got $10,000, and that's all I've saved up. What can I do with it to get myself started? So questions like that, questions that really drill down in, like, hey, I don't understand this terminology that you're using regarding supply and demand. What does it mean when you say this? Like, what's equilibrium and what's supply and demand and how does that all work? Questions like this. So that's Straight Talk Investing. But the rest of the week is videos about the economy. So I posted one today, actually. I don't know if you saw it yet. Posted something about Bitcoin. And in the last real briefly, in the last 6 months, it looks like Bitcoin is forming a descending wedge in its chart. And I think it's a very bearish signal for Bitcoin. So Bitcoin now is at what, like $6,500, $7,000,
Mm-hmm.
and 6 months ago it was $12,500. So, okay, thanks. What does it mean that it's forming a descending wedge? Okay, well, it means that it's a bearish signal, and we think the price is going to go down further. In the video, I said it looks like it could go down to about $2,000 to $3,000 from where it is now, and especially if it hits the prior base from that wedge. The base right now is about 6,500. The prior base to that, I think, was around 4,500, 5,000, if I remember correctly. So looking at that Bitcoin chart, like, where's Bitcoin going? Yeah, I see you looking at the chart. That's in the last 6 months there. Yeah, if your bottom red line, if you bring that more parallel to the bottom of the chart, that's going to show the wedge.
I've never
So that was the video I
wedge,
posted today,
and
that's just I don't know if you're for your listeners who are proficient with charting, which I'm certainly not, but for your listeners who are, they'll see that descending wedge right away. For the listeners who are not, if you're just going to draw a horizontal base where the candles are on the right hand side of the chart, a horizontal base going from the right hand side of the chart straight across, right there where Jeremy's drawing it now, and then right about there, and we got a wedge.
Gotcha. Interesting.
So that's what I spoke about.
How would that
morning.
impact the economy, in your opinion, or does that have any impact, or is that just something that
for the economy, it doesn't impact the economy. One of the things I like to do with my videos is make sure people know how things are impacting them and how they can benefit from it. So, if gold is in a rising pattern, well, how do I benefit from it if it falls off by $30 tomorrow? Well, maybe that's a good time to buy, maybe it's not. So in this case with Bitcoin, it doesn't really impact the economy per se, but it may impact individuals. So if somebody's looking to day trade Bitcoin or any of the other cryptocurrencies, God bless them. Let them go ahead and do it if they know how to make money on it. If somebody doesn't know how to trade it, though, I don't recommend going into crypto at all. That's my baseline recommendation. Trade it if you can. Otherwise, stay out. It's not an investment. And I know that's controversial, Jeremy, especially with people who have a disdain for the government. I get that. I just don't like Bitcoin for a lot of reasons. Not any of the cryptos. So it doesn't really impact the economy. Maybe, like an individual, the people that they call a whale. So maybe he's able to sell 100,000 coins today at $7,000. And he's going to walk away with what, 70 million or $700 million. And now he can go buy his fantasy island down in the Caribbean somewhere and build a house for himself and his family. I don't know. But
yeah.
for the economy as a whole, it's not really affecting the economy as a whole. It's just it's not such a thing that's so widespread. Like when you're looking at unemployment, that's something that takes into account everybody who's working and everybody who's not. When you're looking at housing, that takes into account probably 20% of the economy. If housing prices are rising, if housing prices are falling, if mortgage applications are rising or falling, if refinance applications are rising or falling, if housing starts are rising or falling, this probably takes into about 20% of our economy.
Sure.
Because it's not just the house. It's the guy who builds it. It's the guy who puts the electricity in, the plumbing, the HVAC, the attorney that you hire to help you close the sale, the attorney that the other side hired, the banks that are involved. There's just so many people involved with a home purchase. So when you look at that, it's really a good gauge for the whole economy. And by the way, that's why they say as housing goes, so goes the economy.
Yeah. Tell me,
but things like Bitcoin, or shares of Microsoft, if that impacts the whole economy, I don't think so.
Yeah.
Not at all.
Can you give me like just a random guess or thought or perspective on where does the broader markets go from here with the impeachment stuff happening kind of today? Do you just have any kind of speculation or prognosis on what you see the big picture doing?
Yeah, so big picture, as far as the S&P, wow, it's a fantastic chart to look at because it's really just it looks like a rocket ship straight up. Um, my problem with the S&P, with the broad stock market, and impeachment or not, I don't care. That's not going to have a profound effect on the economy. On a minute-to-minute basis, things may be very volatile depending on the news. But in the long term, we're not going to see an effect just because Trump is impeached or because he's not. And once he's impeached, is he going to get thrown out of office or not? Well, if he goes to trial and gets thrown out, Mike Pence is next in line to become president. And he's probably going to continue with many of the same policies that Donald Trump will continue with, at least for the next year until the election.
Yeah.
But, as far as the news cycles, I'm more concerned with trade wars because that has a direct impact on the economy. I'm more concerned with, like if there's something that's happening in the banking industry, if the Federal Reserve is raising or lowering rates, and if they're buying or selling treasuries, or if they're just taking a very hands-off approach. So when you look at this chart, the S&P chart, it stands out to me that, number one, it looks like it's going straight up almost, except for that one spot over there at the end of 2018 where it goes down, very pronounced. It goes down, very pronounced. That was what we called the taper tantrum. And the reason for that, Jeremy, was that the Federal Reserve had raised rates again in the last quarter of 2018, and markets didn't like that at all. And I've been saying for quite some time that as the Federal Reserve raises interest rates and as they sell bonds and mortgage-backed securities, that's going to be really bad news for the average consumer. It's going to be really bad news for companies. One, because rates are going up, which means if the rate on my credit card as a consumer is going up, I have to spend more money every month to service my credit card and keep it on time. If I'm doing that, that means more cash is not available to me to spend for groceries, to spend for electronics. I mean, we're in the holiday season now. Maybe my kids want a new game for their PlayStation, or maybe they want certain toys. So people are spending less money as their interest rates go up. So I was very concerned about that as the Fed was raising rates and selling bonds, because it was a double whammy for interest rates. Because you see, as they're selling bonds, the price of the bond is going, all else equal at least, the price of the bond should fall. The reason for that is because they're adding so much supply into the market. If there's no one else around to soak up that supply and buy it, the price should fall and the interest rate should rise. As the price of a bond falls, the interest rate always rises, and vice versa. There's one exception to that, but it's not worthwhile to talk about it. It's a very obscure exception.
Yeah.
But generally speaking, as the price goes up, the bond yield will fall. As the price goes down, the bond yield will rise. So here you have a situation where the Fed is raising rates, and on top of that, they're selling bonds, which put more pressure on rates to rise. And that's what happened. And that's why we had the taper tantrum, because that all came to a head last year in October. And I predicted very clearly in my writings that it would happen in the fourth quarter of 2018. So I like on the one hand, I'm happy I was right about it. On the other hand, it's like very sad what's going on these days with monetary policy in our government. It's very disappointing, So as far as that chart goes on the S&P, it's going up. Yeah. The people who benefit most from the S&P going up are the institutions, and we can benefit from that also, by the way, because anybody who has a job where there's a 401k or a 403b, any of the retirement type of funds, or a college savings fund, a 529, anybody who has an IRA with a few $1,000s, most of the time people are in either shares of their own company or they're in index funds like an S&P index fund. So people are benefiting from that as shares rise. At this point in time, though, regardless of what measure you look at, stocks are way overvalued. But by almost any measure, the favorite one that I have is Warren Buffett's measure. What's the ratio of the stock market to the GDP? So right now, the stock market is about 150% of GDP, and it's normally that the average is about 50-55% of GDP, maybe 60%. So if just looking at that, that means that the next time there's a recession, well, stocks could crash by 50 to 70% to revert to the mean. Which is a huge crash. Now you could benefit from that. You could short the stock market once it all starts to happen. And even if you don't, if it goes 50% and you only grab 40 out of the 50%, that means you'll make 40% in about 18 months. Is anybody going to cry that they made 40% in 18 months if they short the market? I don't think so. I think anybody who makes 40% in 18 months is going to be awfully happy about that.
Well, which I would agree. I mean, they'd have to be happy to some extent because that's how they make money.
Yeah, for sure. On the other hand, if you leave everything in the S&P fund, like the last time there was in 2000 when everything came crashing down, it took the NASDAQ from the year 2000 all the way until about 2017 or the beginning of 2018 just to break even. So if you stayed in for those 20 years, your retirement funds, not counting any additions you made, but your retirement funds had just broken even. And then if you take into account inflation, you're behind. So how does that help? It doesn't help.
Yeah. So question, Howard, last one. Do you think the U.S. will ever see negative interest rates?
I definitely think we will see negative interest rates in America. And it doesn't matter if you're talking about nominal interest rates or real interest rates. So just so your audience knows, nominal interest rates are the stated interest rate. So, for example, if you buy a bond from Bank of America and the stated interest rate on that bond is 3%, that's the nominal rate. Then when you subtract inflation, inflation is what, like 2.4 now? So subtract inflation, I think I said 3%, right? So 3% minus 2.4%, you're really gaining 0.6% a year in actual purchasing power. Meaning, if you have $1,000 that you're investing in that bond, and let's say you could buy 2,000 pounds, 1 ton of potatoes with $1,000. So next year, because of inflation, you're going to need $1,024 to buy the same ton of potatoes. But if you put your money into a bond, and again, there's that term again, money. I'd rather say cash. If you put your cash into a bond, you'll come out with $1,030. Which means if you then buy that ton of potatoes for $1,024, you'll have $60 left over and you can buy more. So again, the stated interest rate on the bond is the nominal rate, and the real rate is the stated rate minus inflation. Now, as far as interest rates going negative, so if you bought that bond for 1% and inflation is 2.4, you've got a negative yield on a negative real yield on your bond, even though the stated yield is positive. But if you want to know if the Fed is going to go negative, I'll send you the link to this. The Fed is definitely going negative. Back in, I think, the end of May or beginning of June, the Chicago Regional Fed had a gathering with all the Fed governors and top officials. And it was kind of quiet and not spoken about. I wrote about it and spoke about it, and you can find it on LinkedIn. You can find it. Oh, Talk Markets was that third website. You can find it on Talk Markets also. The Fed gave there was an introductory speech. Then Jerome Powell, the Fed chairman, gave his speech, and the first keynote speech after Jerome Powell was by 4 or 5 professors. I can't remember all their names off the top of my head, but it's irrelevant. These are people who are top Fed officials. They wrote a paper, and on page 2 of that paper, which is also linked on the Chicago Fed website, They said that in the last recession, meaning 2007, 2008, what we call the Great Financial Crisis, they said that in that recession, if we had lowered the overnight federal funds rate by 8 to 10%, we could have completely avoided a recession. And that's the blueprint going forward, is to lower rates by 8 to 10%. So now, in the last recession, the Fed funds rate was 5.5% approximately before they started, maybe it was 5.25, something like that, before they started lowering it, and they lowered it all the way down to 0. And that's about average for the Fed. They lower interest rates between 5 and 5.5% in a recession in order to help juice the economy and get back out of the recession. So they were talking about going 8 to 10%. So that means that they thought the Fed should have been -3 to -5% in the last recession. And from where we peaked this time around at 3%, that means they think that we should be -6, -8% the next time we have a recession. So I wouldn't be surprised at all if the Fed goes negative and very quickly.
Wow.
Because I wouldn't be, and again, it's in a paper. It's a published paper that's peer reviewed, and this is what they're proposing, and it's very scary. I mean, Janet Yellen, it's so ironic. She said, like, maybe a year and a half, 2 years ago, I don't think we'll ever see another financial crisis in our lifetimes. So Janet Yellen is what, 65? Does that mean in the next 25 years she's not going to see a crisis? But now, in the last 2 weeks, she said, I'm very concerned with pensioners because the interest rates that they're getting on their bond portfolios are not high enough to sustain their lifestyles, let alone even paying rent or mortgage and buying the food they need to eat and the medical care that they need to sustain their lives. And she's one of the people responsible for the current crisis that we have with interest rates. So how does she say, on the one hand, there won't be a crisis? On the other hand, she says there is a crisis. And if that's bad now at 2.5%, 3%, if that's bad for pensioners now, you're talking millions of people who are already retired and millions more who are getting ready to retire in the next 15 years. If this is a crisis now at 2.5%, 3% on their municipal bonds and on their treasuries and on their corporates, and this is supposedly investment grade stuff, if that's now, what's it going to be when a recession hits and bonds go negative? They're going to invest $100,000 from their retirement portfolio into a bond fund, and they'll get a negative yield of -3 or 4 or 5%. So they're going to come away a year later with $96,000, and a year after that, $93,000. How are they supposed to sustain themselves? I mean, it's just remarkable to me that these people can get up in front of a microphone and say the things that they say. I mean, don't get me wrong. I'm certainly a novice compared to these people. They have PhDs. They have a much greater understanding of what's going on in the country, much more access to data than I have. But you don't have to be one of these people to see what's going on, Jeremy. You really don't. You don't have to be you don't have to be the Albert Einstein of the economy to understand how the banking system works. There's a great video series, by the way, just as a side note. Mike Maloney made a great video series called The Hidden Secrets of Money. I think everybody should go watch episodes 1 through 6. It's amazing. It explains the entire banking system and the entire monetary system that the entire world operates under. And once you watch that video series, it's about an hour each video. Once you watch that series, you can't unwatch it, and you'll understand why I recommend gold and silver and all the recommendations that I'm making and all the things that I'm seeing going on in the economy. You'll understand immediately. It's 5 or 6 hours of your time, and it's worth it.
How's it spelled? Mike Maloney?
Mike Maloney. Yeah, just look up The Hidden Secrets of Money. And that'll come up.
Best believe I'll be doing that.
It's so worth it. It really is. If people get nothing else out of my interview with you, yeah, that's it. You get nothing else out of this. Start with episode 1 on The Hidden Secrets of Money. It's going to blow your mind.
Consider it done.
It's going to really blow your mind.
Consider it done. I'm going to end on that note, Howard. That was, believe it or not, man, that was a good 50 minutes already. That was incredible.
Wow.
Thank you for the insights, sir.
You're welcome. I'd love to do it again if you're open to it.
I will be reaching out, my friend. I'll send you a copy of the recording, and we'll keep in touch. So thank you so much.
Great. You mind if I post it to LinkedIn?
Oh, not at all. I would love it.
Great, great. So I'll make sure to do it. Or maybe I'll just copy yours and when you post it.
Yeah. Either way, man, thank you for your time. You rock, buddy.
All right, man. Take
care.
care. Have a great day.
Yep. So folks, some good insights, some good education. Again, one of my goals is to surround myself with people who know more things than I do. And I could not have had that conversation from the other point of view. So it's always good to reach out and to ask questions and to learn. And even if you get one small takeaway, one grain of knowledge salt that can be used towards your growth and your progress, your monetary progress, financial freedom. Let's go get it, folks. You're amazing. Thanks for tuning in. Thanks for listening. Thanks for watching. Thomas, thanks for being here. And everyone else who listened in, I appreciate your time and energy. I will see you all later. And until next time, love life, live life, and trade it. Bye.